This is going to be recorded. Cowabunga Buffalo Bob. I like it. Morning, Ron. Good morning, Steve. Morning, Joel. Good morning, Erla. B. Hayes. Great to have you in here. Welcome to the room. Guys, welcome to the Nexgen Education Room. I'm Mark. I will be your host for the next 3 hours. I want to share two things before we do anything. The first thing is that if you are brand new with me, and you know who you are, your first day with Nexgen in this room feels very much like this picture looks. It feels like there is a flood of information coming at you, and you're trying to figure out how to get to the finish line with everything coming at you. And I'm going to tell you right now, this classroom is designed to take away this overwhelming feeling, to keep it very simple, very focused. Simplicity is really kind of what I do each and every day, and we're going to focus on that. And if you allow it to be that simple, as it's taught in this room, what happens is it takes very simple concepts that we learn, and then we're going to turn those into trades. So just trust me. If you're feeling this way, it's normal. I felt the exact same way when I started with the software, but there's a way to get around it, and that's exactly what we're going to do today. So we're going to start the way we start every day. We're going to go to forexfactory.com. Today is Wednesday, February 19th, and we're going to check news. We're going to see what's going on in the wonderful world and see if there is any high impact scenarios that could affect the movement of the market, the pace of the market, and if there is, I personally am going to choose not to be in the market during those times because I just don't know what the reaction is going to be. Normally, crude oil traders, you're like, hey, today is going to be crude oil inventories, but because of the holiday, you'll notice that that's tomorrow. But what we do have today are those FOMC meeting minutes, guys. At 2 p.m. Eastern, the S&P, the NASDAQ, it is going to unleash hell's fury and look like a seismograph for probably as little as 5 minutes and up to 2 hours. So FOMC day, guys, is one of the most volatile moments that you'll ever see in the market. If you've never seen it, watch it. I don't give trading advice, but if I were talking to my son who wanted to trade today at 2 p.m., I would say under no circumstances, son, should you consider trading FOMC. It's really just too volatile. But every morning I come to forexfactory.com/calendar and I just check news. I'm making sure that I'm not in a trade when that market could react, and that is the high impact boxes. So 2 o'clock's the only thing for today, and then there's nothing going on until 8:30 a.m. tomorrow. Everything that is discussed in this classroom can be found on the Nexgen website. I'm going to tell you guys right now, I don't keep secrets from you. I don't give you every possible way to use the software because, let's be honest, that would take about 18 days straight because there's a million ways to use the software. What I do is I teach you the highest probability way. All the answers, everything that I talk about every day comes from the trading guide. Whoops, I'm going to continue to my destination. Under the trading plan, this is pretty much the first hour of this classroom. It doesn't really change in the first hour. It's the same thing over and over because I firmly believe repetition creates recognition. Pardon the scroll. I know that's tough on some people's eyes. Every morning for an hour, give or take, we talk about what's called a high probability trend trade. A high probability trade is defined as when each indicator on every chart agrees with the rules for the trade. This is when your triggers are the strongest, when no termination conditions exist, when there's nothing between you and your targets. This high probability trade, guys, is laying a foundation for you. This is not the only trade that you can take. This really isn't even your get rich trade. This is the trade that's going to teach you to see your get rich trade. This is the trade that's going to get it to where you can see the patterns outside of the very basics to find more with the software. This high probability trend trade, as it is discussed each and every morning, is a trade that when you follow the rules, typically wins 70 to 80% of the time. Ron, I owe you a sack of nickels. One day I'll make it to Myrtle Beach and I'll bring that sack of nickels with me. Guys, the high probability trend trade is a trade that typically wins 70 to 80% of the time if you follow the rules. The high probability trend trade, no kidding, is a trade that creates confidence through that memory of success. I'm a big fan of that phrase. Confidence comes from the memory of success. So it stands to reason that we put you in a position to have as much success as possible as a brand new user. But the one thing that the high probability trend trade is going to do for you, learning this trade, learning these rules, is it's going to turn you into a chart reader. You'll be able to look at your indicators and you'll be able to say to yourself, this is where the market is most likely to continue, and this is going to become an entry point. And you'll be able to say to yourself, that's where the market is most likely to go using momentum, using Fibonacci, and this is going to work its way into your targets. And finally, you're going to be able to say, this is where the market is likely to stop. I'm going to make the choice not to trade into this key area. I'm going to make the choice not to try to catch that next trade because this is an area that could reverse the market. The high probability trend trade is designed to make you a chart reader so that you can make these good decisions. Let me get my laser pointer. Pew, pew. And what you're going to find is that 90% of your day is doing nothing other than looking at your indicators and waiting for a couple advantages. 10% of your day will be actively trading. So you guys that are a little newer with me, that every time you see the market move, you're wondering where your entry was. Well, your entry will be at the point where your rules were met. And if your rules were not met, guess what? You simply didn't have an entry. You're in one of those 90%. I posted in the room earlier about a trading edge. And a trading edge is a trading method or approach that helps to accumulate more profits and losses. Guys, this pattern, these rules, this is a trading edge. These are the rules for the high probability trend trade. Each rule, when true, gives you an advantage. Rule number 1 in white will give you the advantage of momentum. Rule number 2 will give you the advantage of a clear path. Rules 1 and 2 are your core, are your foundation. This is the solid base on which you're going to build your trading career using this software. Because once you can identify momentum and once you understand clear path, guys, the world is your oyster. You'll find so many opportunities. You will manage so much more effectively. So I'm going to encourage you, instead of looking for trades as a brand new user, let's learn how to identify momentum and a clear path. And then rule number 3 is specific to a trend trade. And what it does is it puts you into the market. It defines where the market is most likely to continue, and that becomes your entry. These 3 rules happen on only 2 charts. And I'm going to tell you guys right now, because some of you are going to feel left out. You're going to see people using other charts, and you're going to wonder, well, why can't I use other charts? Guys, all you need to learn this high probability trend trade is 2 charts. Keep it simple in the beginning. There's no reason to overwhelm yourself. You've got the rest of your life to complicate things. Let's keep it simple. On the most current bar, the first printing bar on your large chart, guys, this large chart is a slow chart. It's a very broad stroke of a brush. It's difficult to see change happening on the large chart. So the large chart is going to define the direction of the market. The large chart will define the momentum in the market through rule number 1. And the large chart will define the areas that may be problematic, that could be targets. And all of this happens on the most current bar. It takes 1 bar to define direction, momentum, and areas. Your first 2 rules, providing those first 2 advantages, are met on the large chart. The large chart leads the way. Once they're in play, once you have momentum, Once your path is clear, you're going to find your entry. You're going to go to a smaller chart. And the smaller chart is nothing more than a refinement chart. It gives you an X-ray of that one bar. Because inside of that one bar, I'm going to show the picture today, is an entire pullback, typically a bounce, and continuation down. So the black box around the one bar is all of this action on your smaller chart. It's just a refinement chart. It's a way to take this great information and these two advantages and pinpoint your area for entry, and that's going to allow you to reduce risk, and it's going to allow you to increase profit potential. So rule number 3 is a small chart rule. Rule number 3 is an entry rule. We use these two charts, and only two charts, because it's easy to go with the analogy by asking yourself, who am I trading with or who am I trading against? Large chart, big chart, slow chart. Guys, this is the big crowd. These are the men and women with more money than you. They get invited to more parties than you. They drive nicer cars than you. These are the people, when they wake up and they want to create an uptrend, you're going to get an uptrend. These are the men and women that flood the market with money and create the momentum that we look for. These are the same people that react at key areas. And we know exactly where their reaction is most likely to happen. So trading with the large crowd, never fighting the large crowd, tends to be the path of least resistance. Your small chart, I want you to think of them as the small crowd. They still have more money than you. They still have more influence than you. And they create pushes, what we call retracements, these little shoves down when the large crowd wants to go up, or little shoves up when the large crowd wants to go down. The cool thing is that we know through a little bit of study, well actually almost 30 years of study, that the small crowd typically fails 70 to 80% of the time. The small crowd's failure point can be pinpointed with rule number 3 on a smaller, faster chart. And if they're losing 70 to 80% of the time, well, you have the potential to win up to 70 to 80% of the time. So remember who you're trading with, guys. And let's talk about how we're going to do the day. Same way we did it yesterday. Cool thing, same way I'm going to do it tomorrow. Because when you hear the same thing repeatedly, what happens is it begins to stick. And then when you practice the same thing repeatedly, it begins to stick and everything gets easier. So we're going to take the first hour and we're going to learn the Fibonacci and the trigger line rules for when it's okay to trade. It's okay to trade when my rules are met because my rules are describing a pattern that has been proven to win more than it loses. It has been tested, it has been verified, it has been validated, and you're going to learn to trust the idea that you shouldn't enter the market if those advantages aren't present as a brand new user. You have the ability to simulate. Avoid the temptation to wait until you've got this down to try to practice. Guys, practice from day one. Get in on the simulator on day one. Practice moving stops, entering trades, taking losses. Yeah, practice taking losses and being okay with it if it's the right loss. But here's the first step in becoming a confident trader ASAP, guys. Post your pictures in the room. Every time you take a trade, take a picture. Every time you take a picture, annotate that chart. Go back to those 3 advantages and write them down on that chart. Strong triggers, clear path, where was your entry, where was your exit, and guys, tell me why. Because every time you post in my room, it's a private session. Every time you give me something to look at, we talk about it. We celebrate what's great. We talk about what could have done better, maybe where you could have reduced risk, where you could have maximized profit potential. And more importantly, you're going to begin to recognize these patterns a little faster with a little bit of feedback. So post in the room. And then we're going to simplify. We're going to break it down one trade initially, and then we're going to give you a plan. Me and the mouse in my pocket are going to give you a plan called the KISS plan. And the KISS plan is designed to optimize your chances of success using this high probability trend trade. That same plan has a second trade, but it's pretty necessary that you learn the very basic concepts first to be able to capture this second trade. You've got to learn what looks you're going to commit to, guys. Remember, all this is patterns. The market does the same darn thing every day. We have identified, written rules for, so that you can capitalize on this pattern. You've got to learn these looks so that they become easy. That's the second piece of getting to where you want to be. Use the spreadsheet. Nexgen gave you a spreadsheet. It's in your study guide folder. If you haven't looked at it yet, there's mine. And I did a little rearrangement, guys. My first tab is now the basic rules. But not even the entry rules on this one. This first tab identifies the first two rules being met in green. These are pictures that I've taken that have been annotated showing you exactly why these rules are true and what they mean to you. And then the red section is what it looks like when they're not true. And this is your 90%. This is your, oh my gosh, my rules aren't met. Let me sit on my hands and do nothing rather than try to trade without that advantage. The second tab, is about 400 pictures in the green section of Nexgen users doing amazing things with this software. When you guys drop something in the room and I click on it and I'm like, all right, let's see what you did, Bob. And Bob says, check it out, Mark. I had all of this momentum, but it was into a termination. And then 3 divergences told me, don't go short anymore. And what this is Bob not even taking a trade, but rather taking that idea that when he does not have a clear path, he doesn't want to take the trade. So Bob, I'm going to put you here in the study guide under termination conditions. And we'll just call it Bob's Great Term Read. But that's what we're doing, is we're taking your pictures, we're talking about them, we're making sure they're accurate. And guys, I'm gonna steal them from you. And I'm gonna turn your greatness into a study guide for everyone else. Also in here, we've got clients' perfect trades. We've got the entry sequences for longs and shorts, pinpointing on a smaller, faster chart precisely where the market is most likely to continue. There's a very mechanical management plan. This is going to be given to you in written form. This is it visually, so that you know exactly how you can be very mechanical and pragmatic in your management as you learn to read your indicators. And then there's a lot of ideas on maybe when to hold for bigger moves or get out a little sooner. You're going to begin to recognize patterns, because patterns repeat themselves every day in the market. As you begin to see things, you're like, oh man, I've seen this before. Take a picture, drop it in my room, let's talk about it. And I take this picture almost every day, it feels like lately. And I'm going to show it to you. Maybe I accidentally deleted it. I want you guys to see something pretty cool. Dagnabbit. There's a couple of them, and I don't know where the other two went. So this is a pattern on NASDAQ that's also happening on crude oil. And this same pattern, let me go back and find it because I took it the other day as well. But this exact same pattern, this exact same look that really, I won't say predicted, but lets you know exactly where a reversal in the market was imminent. And I can't find that other picture. There's just so much going on. I've taken 4 pictures of it in the last 2 days. And it's the exact same pattern, and there's like the exact same result. And what it was a reversal. So we're really spending a lot of time recognizing patterns, and we're going to use them to our advantage. There is the build your plan section. This is where you're going to take the rules for the high probability trend trade initially. You're going to take pictures of it, and you're going to drop it into your personal trade setup looks. And you're going to say to yourself, this is what I need to see to get into the market. The more of these pictures you take, the slower the market appears to move. As you work on management, as you recognize patterns, it's just your own page. It's your personal page. I encourage, I can't demand because it turns out nobody listens to me when I do. I encourage you guys to take at least 15 annotated pictures a day. The people that take the most pictures get to where they want to be the fastest. There's no doubt in my mind about this. I've watched it for the last 5.5 years. I've been teaching people to read these indicators. 15 annotated pictures a day is 300 pictures at the end of 30 days of study. 900 pictures at the end of 3 months, guys, and I'm telling you that it's the repetition of seeing the same thing, of talking through what it is you're seeing. That's what creates the recognition. That's what creates the trust. That's what creates the confidence. And if you look at my totals, I'm at 1,137 pictures, and it is the 19th of February. That's my 2025 count right now. I'm well over 1,100 pictures. And I've been doing this for a long time. I take pictures every day. I annotate pictures every day. The more pictures you take, guys, the quicker you're going to get to where you want to be. So we're going to learn. You're going to practice. I'm going to give you a plan. We're going to create recognition. I'm not, but I'm good at reading indicators, Joe. My promise to you, and I've got some new people in here. My promise to you is that by the end of this day, you will have everything that you need to be successful with the software. You won't have the complete user's guide to the galaxy of using the software, because as you grow, so will your opportunities. But we're going to take an hour to talk about the absolute best of the best together. If you have a question, if you need clarity, I'm going to remind you of this too. The squeaky wheel gets the grease. It's impossible to upset me by interrupting, guys. I encourage interruptions. I want your questions. If you don't understand something, force me to explain it. Don't let me off the hook. I have said the same thing 1,000 ways, and 1,000 people hear it differently. And that's why I do that. So if I'm not saying it in a way that clicks, tell me, hey, Mark, let's find another way to do that. And I will. And I love doing that. That's fun for me. So here we go. Woo! What are we looking at? When I open up my software, what am I looking at? Guys, the first thing you're going to see is triggers. And triggers are the same no matter what chart you're looking at, large or small. There are small triggers. These are the solid lines. It takes 2 solid lines to create the small triggers. They're a fast moving average. And then there's the large triggers, 2 dashed lines. These are a slow moving average. I'm going to tell you right now, you do not need to know how to build a clock to be able to tell time, guys. All you need to know is that these are small and these are large. Trigger lines work their way into everything. We'll use them first to define momentum. We'll use them to define termination conditions. We'll use them to define entries, guys. So just know the 2 pieces. They're either small or they're large. Both small and large charts will have them. Both charts will also have areas. This is what draws most people to Nexgen, are these areas. Understanding where highs and lows can be in the market, and then using just those momentum indicators, those trigger lines, to decide whether or not you should or shouldn't be trading into areas. Every area has a name, and that's all this is, guys. The divergence highs are a magenta line. They print if there's a loss of momentum at a pivot. So if price goes up and then down and momentum is lagging, you'll see a magenta line print right off the top of that pivot. If the same thing happens at a low, you'll see a cyan line. Those are fancy words for pink and baby blue. You're going to see Fibonacci resistance. Anytime the market is trending up, resistance is a point where the market may stop, bounce, or break. You'll never know what it's going to be. Fibonacci support is the blue line, yellow 1-to-1s, and then you'll see the mid band. And the mid band just kind of squiggles right through the middle of your charts, and you'll see it on both charts. Depending on the chart, the areas will have a different role. Depending on the chart, the triggers will have a different role. So what we're going to do is we're going to define them and how to use them. And we're going to start on the large chart, because the large chart leads the way. You should write that down. Large chart is going to define the trend of the market and let you know which way you should be trading. And then once it does that, it has to have strong trigger lines. So trend is the easiest lesson you'll ever get. It's either green or red behind that first bar. If it's green, the market's going up. Your job is to look for rules to be met for high probability trend trades long. If it's red, the market's going down. Your job is to look for rules to be met for high probability trend trades short. And then the only way you can have strong triggers is to trade with the trend. How cool is that? How easy is that? The trend is your friend. In an uptrend, when the background is green, both the large and the small triggers must also be green. If your trigger lines don't match each other in color, like this, or your trigger lines don't match the background, rule number 1 is not met, and it's okay to sit on your hands and wait for that advantage of momentum. In an uptrend, though, when the small triggers break above and away from the large triggers, when there is space between the two, or in a downtrend, when the small triggers break below and away from the large triggers, there's space between the two. I like you guys to picture scissors that are opening up. And as those scissors open, momentum increases. When I have this look, I have strong triggers. Strong triggers means that the odds are favorable for the market to continue in the direction of the trend. You're going to see it annotated on charts posted in this room, OFM, and you're going to see that all day long. OFM, OFM, odds favorable. Odds favorable is the best of the best. But odds favorable doesn't last forever. If there can be strength, well, then there can be weakness. When your small triggers return inside of the large triggers, this is what we call a weakening of the large triggers. And when I have weakness, anything can happen up or down. ACH, you're going to see that on charts. Anything can happen up or down. And all it is you acknowledging this market has the potential to keep pushing, or this market may retrace, or this market may bounce, or that area may hold. And all it is identifying an advantage and saying it out loud. I want to, I'm going to pull pictures out today. Dun, dun, dun. Oh. Black Prince, can you take a picture and show it to me? That would be awesome. I want you to get in the habit. I'm not going to read your charts for you. I'll give you my 2 cents. But remember, you're learning to read charts. My chart says odds favorable, momentum up. Do you see it? I've got strong triggers to the upside. I'm not even thinking about anything other than looking for the entry. But you're getting ahead of us. I can't call your shots for you. I'm not allowed to. It's illegal. But I can tell you rule 1 sure is met here. That's the best looking momentum that I've ever seen in my life. Show me a picture. Write your rules on it. I can tell you that rule number 3 says pull back to an area inside of triggers. And I see an area inside of triggers. Sounds to me, Black Prince, like you're getting the hang of this. Nicely done. But let's get back to the basics. Strength pushes a market. Strength has the potential to break areas. Strength can cover mistakes users make. Weakness is literally the market telling you, we could do whatever. We're not likely to push in the direction of a trend. When you have strength, from the point of separation until it closes, this is where, like Black Prince just said, you're going to look for pullbacks on a smaller, faster chart. You're going to look for an area inside of triggers on a smaller, faster chart. On your large chart, you're going to see these tails or these wicks. Rule number 3 is designed to help you pinpoint where the bottom of this tail is most likely to form. And when you see it, you can circle these, and you'll use that to go back and study those patterns, whether it is a short or a long. Black Prince, I'm not sure you got your pullback. I know you were looking. That's the Nexgen momentum trade right there. Breaks above, snaps back. There's an awful lot of people in this room that may have taken an entry right there. And when we talk about entries, I like it. I'm going to go back, second hour, Black Prince. and we're going to talk about your chart 100% if that's okay. I want to go through the rules for everybody so they know what I'm talking about when I look at your charts. Cool? And that's why we do the rules first, guys. So I'm going to ask real quick, is everybody okay with that? Momentum is defined on the large chart, on the first bar. This is strong triggers, separation between the small and large. Black Prince recognized it. He was looking for a long trade to go up with that momentum. I love it. Once you have momentum, thanks Jeffrey, got to make sure there's nothing in the way. We're making sure that there's no termination conditions. And a termination condition is one of those Fibonacci-based indicators. Remember that those areas that we talked about, support, resistance, one-to-ones, divergence highs, divergence lows? Every one of these areas has the potential to stop the market. Every one of these areas is where that large crowd is likely to make a decision to buy or to sell or to fight one another. Sometimes reversals happen here. Sometimes they break. The reality is that you guys will never know what the reaction is going to be. But if you say to yourself and you believe in the idea that decisions are made at these key areas, you just gave yourself the ability to recognize, one, where the market may go, and two, what we're talking about right now, when that area may stop the market. So we're going to let price, those dynamic Renko bars, reach the area. That's what sets off the decision-making process. So the first piece of the puzzle to defining a termination condition is allow price to reach the area. Allow price to reach resistance. Allow those price bars to reach support. Once price reaches an area, all you have to do is ask yourself, where are my triggers? If price reaches resistance and your trigger lines, small and large, remain below that area of resistance, that area is a termination condition. If price reaches support and your small and large triggers remain above support, that support is a termination condition. And guys, something's probably going to happen there. You're either going to get an untradeable bounce that would take you out of a long position or a short position. The buyers and sellers may fight for a minute as they jockey for position to see who's going to take over. Either the sellers are going to take over and create a reversal, or the buyers are going to continue their push through the area. And trading from key areas, trading to get to key areas is always more advantageous than trading directly into a key area. If that termination condition at a high reverses the market, that's what we call a strong top. And a strong top is the precursor to the highest probability trend trade that you could ever take. A strong top is rule number one for the other trades that Nexgen teaches. Strong bottom, if it reverses, precursor, sets you up for the highest probability trend trade. Rule number one for the other trades that Nexgen teaches, guys. So this is what it looks like when the market reverses. And this happens all day long. And let's just see if crude oil wants to... Price reaches resistance, the triggers don't break, and look, it pulls all the way back to support. And here at support, the triggers don't break either, and that's where the market continued up. Dun, dun, dun. Support creates a big bounce, resistance reverses the market, support creates a big bounce. So they hold even momentarily more often than they break. And it's that untradeable bounce that would ruin your good time. So wait for the reaction. Every time price reaches an area, wait for the reaction. If the triggers remain below resistance, just wait for the reaction. See what they're going to do. You don't have to predict. We're better than that. If it's going to break, your small triggers will absolutely smash through the area. Your small triggers will crank 2 to 3 points through that area. And as long as you have odds favorable momentum, as long as strong triggers are present, that area has the potential to break. But it's not broken yet. which means that if you take a trade and there's a lot of opportunity on these potentials to break, you have to manage a little more assertively because it's not a clear path. Once both triggers of the small and both triggers of the large get through resistance, now resistance is broken. Now your path is clear, and it remains clear until you reach the next area, at which point the process starts over. You'll see that resistance behaves as support once it's broken. And go in the other direction, price reaches support, triggers above. Even if it's for a moment, absolutely no trades into that area. Let's wait for the reaction. If the smalls absolutely smash, embrace that phrase, smash. Little prairie dog peeking through is not smashing. 2 to 3 points. As long as you have momentum, that area has the potential to break. But it's not broken until the small and the large get below support. So this one has to be managed assertively. This one is just look for an entry. And you'll see that support behaves as resistance once it's broken. And I think we had a pretty good example of that, where resistance breaks and the market pulls back to it as support. Resistance breaks, market pulls back to it as support. Dun, dun, dun. Yellow 1-to-1s, which could have been support, market pulls back as resistance. So you see this a lot. You see them retest these key areas because these are their decision-making points. And guys, there will be times when your path isn't clear because you start to get these stacked areas. Have you done that yet? Have you said, man, I've got the best momentum ever, but I keep hitting these damn fibs. I can't get around rule number 2. I have to do nothing. And maybe 2 of them break and you're like, to hell with it. I'm taking the next one. And then sure enough, the market reverses. Guys, this is 90% of your day. 90% of your day is doing nothing. It's okay to do nothing. You need to be a professional waiter before you're a professional trader. The futures markets trades billions hourly. Trillions is exchanged every day in the futures markets. It's not necessary to be in every move. Put yourself in the best moves where there's an edge, where you have that advantage, where you're trading that pattern that's been proven to win more than it loses. And then once you have momentum on the large chart, and let's go through it. And guys, I want to make sure everybody's good. Large chart led the way. We let it define direction. We let it define momentum. We let it define the areas. Rules 1 and 2 were met, and it looks just like that in an uptrend. Can you guys give me a why if you're with me so far, especially you new users? All we've done so far is define momentum and made sure there's nothing in the way. I'm telling you, that's the keys to the kingdom. Let's go define an entry. Let's refine that 1 bar. And your entry rules say that you're going to be so precise and so specific that you're going to use a limit order. You'll literally wait for the market to come to you. And that limit order, you're going to use it to buy or sell the pullback, that little fight from the small crowd. And you're going to have that limit order waiting at areas. Fibs, mid bands, yellow 1-to-1s. So the same way areas on a large chart can stop the forward progress of the market, we're going to let areas on the small chart create a bounce to continue with that momentum and clear path. And here's the key. You want your areas to be inside of triggers. And guys, that is one of the most important phrases for the brand new user. Areas inside of triggers, because your trigger lines on the small chart, large and synthetic, the 5-1 large and actually the 13-2 large just thrown onto that chart. These trigger lines define where the retracement is most likely to occur. Price returns to large triggers. It's a math thing. I was an English lit major, so I struggle with math things. But I do know it's called the regression of the mean, which means that when price pulls away from that moving average, it tends to return. On the small chart, it'll return to the small 1 large triggers. On the large chart, it'll return to the large triggers there. So by having large triggers from both charts on your entry chart, you can define with pretty amazing accuracy where the retracement is likely to occur, how far down they're likely to push. You can see that it happened again up here too. They pulled right back. So for the brand new user, there's a look that gives you the least amount of risk, the highest accuracy. We call it favorable large triggers. Favorable large triggers means that your large and your synthetic, both sets of large triggers, are wide. They're angled in the direction of the trend. They are overlapping like two snakes riding piggyback, because when they're one on top of another, that's the smallest amount of space where you can say that's where my retracement is likely to occur. And then when you put an area inside, a fib, a midband, or a yellow 1-to-1, you give the market something to bounce off of. It's like a tennis ball, equal opposite reaction. And guys, it's the areas inside of triggers where we anticipate the bounce. So let's go through an entry sequence. Once the rules are met on the large chart, I'm going to turn my attention to the small chart to find my entry. So my large chart already says that I have momentum and nothing in the way. Guys, that's why I covered the large chart. I'm done with it. I don't need it anymore. The first thing I need is a reversal bar on this small chart. I'm going to see it. It's going to be screaming, going without me. I'm going to be absolutely terrified that I'm never going to get paid. And then the small crowd shows up. The small crowd says, hey, let's fight. That reversal bar signals the beginning of the pullback, the beginning of that retracement. The reversal bar is not your entry. And we know that price tends to return to large triggers. I want you to say it every day, 100 times a day, until you believe it. So from the highest point of the large triggers to the lowest point of the large triggers, this is where the market's most likely to retrace. This is where those down bars are most likely to go. And the tighter they are one on top of each other, guys, the smaller this area becomes. That's when the accuracy increases. So from 73.15 all the way to 72.99, $150 worth of movement, 15 ticks is how wide that retracement may occur. But now I'm going to define where it's most likely to bounce. So once I identify where the market may return, I need an area, a fib, a midband, or a yellow 1-to-1. And there's that word again, inside of triggers, inside of that retracement zone, somewhere in between the top of the triggers and the bottom of the triggers. So that big white box we had where it may retrace turned into a much smaller box where it's most likely to bounce. Most likely, not guaranteed. This is our window of opportunity, as I like to call it. This is from the highest point of support to the lowest point of support. This is where the small crowd is most likely to fail. This is where the market is most likely to bounce and continue with the trend. Guys, this is just a pattern that Nexgen's been teaching for 20 plus years. Little bit of study, you're going to learn to trust this pattern to the point to where you're going to activate a limit order a tick or two above that highest point of support, and now you've done all you can do. The only thing you will ever be in control of as a Nexgen user is whether or not your rules are met, whether or not you're trading a pattern that has been proven to win more than it loses. If the small crowd has it in them and they get back to your limit order 2 ticks above that highest point of support, well, now you're in a long position. You're in a long position having the advantage of a market where the odds are favorable for it to continue in the direction of that trend through strong triggers. There is absolutely nothing in the way on that large chart to create a bounce because there are no termination conditions. And you entered precisely where the market is most likely to continue with that trend. Guys, this is your high probability trend trade. This is the last 30 minutes of this classroom dedicated to defining entries. That's it. We haven't talked about making money. We haven't even talked about management. All we've done is defined right where the market is most likely to continue. For the highest probability, typically wins 70 to 80% of the time. Best chance for success, trade. So let's do it again. Reversal bar signals the beginning of the pullback, is not your entry. It's the beginning of the fight. Guys, if you lose your head and jump in early, that reversal bar is your signal to get the hell out, and let's go define an entry. Once the reversal bar prints, or even on the way up, you're going to look for triggers from the high to the low. This is where that retracement's most likely to occur. Trigger lines are not your entry. It's the areas inside. Fibs, midbands, yellow 1-to-1s. they'll create a window from the highest to the lowest area inside. That's where the market is most likely to continue. Because of large chart advantages, your order goes a tick or two above that highest point of support. Any lines on the wrong side of the triggers, any fibs, any mid bands, any yellow one-to-ones below the triggers in a long trade, guys, this is where your advantage is gone. This is where your edge is no longer with you. Once you blow through the retracement zone in the areas that may create a bounce, there is no telling if or when that market is going to stop, bounce, or continue. In a downtrend with momentum and a clear path, you're going to wait for a reversal bar. This reversal bar signals the beginning of the pullback. It's not your entry. You'll define where the retracement is most likely to go. That's your trigger lines. The trigger lines are not your entry. It's the areas within those trigger lines. And guys, there is one area inside of triggers here. One mid-band where the market is most likely to continue. Your job is to activate a limit order 2 ticks below it and hope the small crowd gets there. Any of those lines on the wrong side of the triggers, any of those lines beyond the retracement zone, beyond the bounce point, this is not a part of the window. Guys, your advantage is gone once you get past those triggers. So now we're going to start talking management. If you can define where the market is most likely to continue, you have just defined it, that's a word, you have just defined where the market should not go. Generally 4 to 5 ticks above the triggers for a short, below the triggers for a long, guys. This is going to be your first stop placement. And you're going to say to yourself, if they want my money, if they want me out of this position, they're going to have to come get me because I've got every advantage in place and I'm not going to offer up myself below an area inside of favorable large triggers. I'm not going to put a stop in the retracement zone. I'm going to force them to do the work to come get me. And here's the part of trading that nobody likes, but it's a fact of life. 20 to 30% of the time, they're going to come get you. Anything that wins 70 to 80% of the time is obligated to lose 20 to 30% of the time. Make them come get you. But the cool thing is, with all those advantages, you're more likely to get a confirmation bar, a reversal bar in the direction of your trend. And guys, this is going to allow you to reduce risk even further. Great entries create manageable trades. So what we need to do is study. Damn it, Mark's making me work. You've got to recognize this pattern. It all starts on the large chart. Large chart, not even looking at my small chart. Large chart has to have strong trigger lines. Otherwise, I'm not looking for a trade. I need a market where the odds are favorable for it to continue in the direction of the trend. Large chart needs to not have hit that next area. I need room to my profit targets. Really want to see at least the potential to break from the previous area. Once I have those, a lot of you are going to panic. Man, Mark, there is no room to get to that target because it's not a termination until price reaches it. Mark, I just don't have room to get to that target when my rules are finally met. Guys, we're not trading from the top of this bar. We're waiting for the reversal bar. We're defining where the retracement is most likely to occur, and we're entering just above Fibonacci support inside of favorable large triggers. Suddenly, there's a lot of room to get to that target. Suddenly, there's tons of room to get to that target. And inside of this one bar is your retracement, your bounce, and your continuation in the direction of the trend. It's the refinement process that allows you to reduce risk. It's the refinement process that increases the distance to your targets. It's important that you learn this pattern. That's where the tail thing comes in, guys. You can go back on a large chart. Let's see if we can find my large chart. You can go back on a large chart, and with momentum and with a clear path, you can define the areas right there at the triggers, and you can say to yourself, this is where the market's most likely to continue. And guys, do you see how we're on the wrong side of the triggers? Large chart is perfect Small chart's on the wrong side of the triggers already. Does everybody see it? This is going to be an important lesson. If every time you look at your charts, you talk about advantages, Wayne, maybe you see that one. And Black Prince, perfect. So check it out. All we're doing is we're talking about advantages, right? So the large chart has strong triggers. The large chart has a clear path. Can everyone give me a Y if you see it? I mean, that's beautiful. The reversal bar prints. There's my trigger lines. But here's my areas. So which area is it going to be? Is it going to be the mid band? Is it going to be the one-to-ones? Is it going to be this fib, that fib? Once I get to the wrong side of the triggers, guys, I don't know. I don't know where it's going to bounce. I've lost the advantage of rule number 3. That's exactly what Black Prince pointed out. So one of the things, when this is ideal and this isn't perfect, some people will say, you know what? If they give me a reversal bar in the direction of the trend with all of this momentum, with nothing in the way, it will at least establish my risk 2 ticks below it. And sometimes people will look for a little confirmation once rule number 3 isn't perfect. Does that make sense, Black Prince? And everyone else in the room. So now I've got some place to put my stop. This wasn't the perfect entry, but the large chart was amazing. It doesn't guarantee a winner, but at least defines risk for you. And I don't know what's going to happen here, but that's just simulator. It doesn't matter. But great chart read, Black Prince. And we'll see what happens when those areas start falling behind. We'll come back to it. And you'll simply start saying, either my rules are met or they're not. And you had 66% of your advantages, but rule number 3 wasn't clearly defined, which means that your advantage, that third advantage, is gone, which means that whatever you're doing can no longer be high probability. All right, so for you newer guys, B. Hayes and Gary, and who else is in here that's relatively new? I came up with this a few months ago because one of the things that I found is that ladies and gentlemen, when they're new to the software, create their own reality of what it means to have strong triggers or what it means to have a clear path. And they don't check with me to verify it. So I'm doing this so that if you're the kind of person that doesn't want to check in and verify your chart read, this is going to get you where you want to be, guys. Because the goal is that you look at your large chart first, that you identify momentum and path. This is the core of everything that you're going to do with this software in one way or another. So take 25 pictures each, and then take the time to annotate right on the chart why the rules are met or why they are not, and then what it means to you in terms of advantages or disadvantages. So do it with strong triggers, weak triggers, a clear path, and termination conditions. And then post those pictures in your spreadsheet. Begin to commit these very simple looks to memory. And what's going to happen is eventually you'll turn them into trades. But if you study these each day, what happens even faster, that drinking from a fire hose feeling goes away quickly because you know you're looking for momentum and path. And I promise you, after 25 pictures and a little bit of annotation, you're going to know exactly what you're looking for. And the only way you will ever trade without your rules being met is because you make the choice to adjust your plan, to risk it because of the advantages, whatever you want to call it. But once you can do this, I'm telling you, it's the golden goose. And as you're learning to do this, I don't leave you guys to your own devices very often. I'm going to give you the high probability trend trade checklist. Guys, this is the best of the best way to enter a high probability trend trade. And it starts with a strong top or bottom. which means that there was a no triggers through the line termination condition that reverses the market. Guys, this termination wasn't a strong top until 8 or 10 bars later. It's the reversal that creates the strength. Termination, now it's a strong top or bottom. It's not mandatory. You can take the trade without it, but it adds a little warm fuzzy to it. You have to define momentum. This is strength. This is strength. This is weakness. As you take those pictures, just go back and try to match it. And then use the words. Why is it strong? Why is it weak? Define your termination conditions. Is it a termination condition? Does it have the potential to break, or is it a broken clear path? And the reason you're doing this is because if you look at your charts and you say out loud, this only has the potential to break, then you know you need to manage assertively. This is a termination condition. Then you know it could reverse the market. You know exactly where the trouble line is, and if something changes, you can manage even more assertively. And if it's a clear path, you might say to yourself, I'm going to relax. I'm going to let that momentum and nothing in the way, hopefully push it to the next area. I'll look for a reason to exit, but if it doesn't give it to me, we're going to ride that wave of goodness. You need to be able to define your entry. Great entries create manageable trades. Great entries reduce risk. Great entries maximize profit potential. So know where the most likely point for the bounce is and get in as close to it as you can as a brand new user. If you're uncomfortable selling the market on the way up or buying the market on the way down, you could wait for that reversal bar. You could say, you know what, I'm going to force it to give me a reversal bar. And then I'll put my stop behind that reversal bar. At least it defines your risk. And then finally, the second page is the trend trade checklist. Print this out and put it on your desk. Laminate it. Use a dry erase marker, whatever. I've never had anybody in the history of this checklist be able to truthfully mark yes to all 4 of these and do worse than 70%. And guys, I have had this thrown through the ringer by a few different engineers. The spreadsheet guys, you know who you are. And they came up with about 82.3%. That's about as exact as I could say. They came up with 82.3%. Following this simple checklist, guys. Following this plan. The KISS plan. And you're going to get this as well, guys. The KISS plan is a stepping stone in your learning journey. That's it. This is the beginning, the alpha. This is the trade. Here comes your nickel run that teaches you to see the other trades. So this is just the beginning, and it's designed to optimize your chances of success with a high probability trend trade as a new user. And then through simulation, study, class feedback, and continuous practice, squeaky wheel, you'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. Guys, once you can talk about advantages, once you can put these things into play, you're going to create your own plan. Nobody ever gets shackled to this plan. But I can tell you that I've had brand new users come in, follow this plan, learn these basic concepts, keep it this simple, and get funded in those prop firms and getting paid out within 30 days because of the simplicity, because of the advantages. So there's 2 things you need to know before you sit down to trade and you're not on the simulator. You have to know why you're going to enter the trade, guys. If you leave it to your guts to make that decision for you, your guts are going to steer you wrong more often than not. Rules are a description of a pattern that has been proven to win more than it loses. I've proven for myself that this wins more than it loses. Nexgen has proven that it wins more than it loses. That's why we teach it. I want you to prove that it wins more than it loses. I want you to go circle those tails, look for those entries. I want you to build trust. Because if you verify it and you trust it, guys, there's no reason to not enter. You know that it wins more than it loses. You know that it will lose. You don't get to pick which it's going to be. So that consistency of entry is what gives you those results. Your rules help remove the emotion of trading, guys. If I know that a coin that I flip will land on heads faithfully 8 out of 10 times, I'm going to bet heads every time. And I'm going to accept the 2 losers that I know are coming. Guys, I don't have to know what happens next when the pattern's been proven. I need to know why I will exit. This is management. And all exits are, you're either taking them at your profit target, or something has changed on the way to that profit target that told you your advantage is gone. That's it. So first you define your entry. First you say, this is where I'm going to get into the market. I'm going to make sure that I have a termination condition that reverses the market. Or even if I don't, I need to have strong triggers. I'm going to have no termination conditions and area inside. There's that darn word highlighted again. Of favorable triggers on the 5-1. If these are met, I'm obligated to enter the market. I'm obligated to get into that market because the advantage is present. And then, here comes the scary part. You've got to do something with that great entry. You've got to manage it now. And KISS management, the written management plan in this plan, guys, this is designed to help you understand and trust stop placement using that phrase where the market should not go. And it's also focused on getting you profits quickly, getting you paid. That's the goal of day trading, guys. The goal of day trading is to get paid. And I'm going to tell you right now, your account, if it's at $500, your account doesn't know if it got there in 1 trade or 10 trades. It's just happy that it got there. So we're going to focus on getting paid and protecting our investment. And your management plan begins with your ability to enter where the market is most likely to continue. So your management plan is going to be if-then. It's going to be very mechanical, and it's going to help remove emotion. I like to encourage you, new users, let it ride out. Don't manipulate your stops and targets as a brand new user. So if the entry is 2 ticks below resistance inside of triggers, then the initial stop is 4 to 5 ticks beyond the triggers. That's it. That's all you can do. And guys, this 7134 entry has $150 per contract of risk on it because that's where the market should not go. You'll know your risk before you ever enter a trade, because you understand the concept of where the market should not go, and you can choose whether or not you accept that risk. If you're not comfortable with $150 per contract, then don't take the trade. But if you put your stop at $50 per contract, it's like they have cameras. They're just going to hit it and then go without you and laugh while you're in the rearview mirror. So if this is my entry, this is my stop, my targets are predetermined at 100 and 200. Remember, we're learning how to get paid. If I don't get stopped out, if a reversal bar prints in the direction of my trade, it redefines where the market should not go. Your new stop is 2 ticks above that reversal bar. So now you have $30 worth of risk. So B. Hayes and Gary and Black Prince and all my new folks, these sniper entries ultimately create minimal risk. And now there's nothing to do. You're either going to get stopped out that $30, or they're going to go to your first target. And the first target's only $100 away from your amazing entry. And if price reaches your first target, 1 contract is automatically removed. This is a 2 contract scenario. It says it on the plan. I don't know if I said it. Sorry. And those funds go into your account. This is success. This is a win. This is a victory. This is where confidence comes from. So with 1 contract remaining, you're going to move your stop to break even. You're going to take 100% of the risk off of this trade, and you've just been paid, and you're feeling good, guys. Your sweaty palms are drying up, and your pulse is dying down. And you now have no risk. Profits have been taken, and if it goes to your second target, guys, that's a $300 trade. And a lot of you are like, Mark, a $300 trade is crap, dude. I can't live off of that. That's 1 trade. That's 4 minutes. If 300 is the best you do every day, it's a $75,000 a year in your trading account. If you add in 1 more trade that's a $100 winner, you're in 6 figures, guys. It's not about catching every trade. It's about being in the best trades, the highest probability trades. It's about making profits consistently. If I hit a home run every 10 times at bat, I still have a 100 batting average, and that's crap. That's not going to get me drafted. 3 base hits puts me at 300. I'm a Hall of Famer. 3 base hits is a $75,000 a year. So I've promised you everything you need to be successful with the software. There it is in a zip file. So download that, drag it over to a file. Inside of that zip file is your daily goals. Inside of that zip file is your KISS plan. Inside of that zip file is your high probability trend trade checklist. Inside of the zip file is chart reading 101. Inside of the zip file is the PowerPoint that I use to teach every day. Inside of that zip file is everything that we've talked about in the last 2 hours consolidated into 2 pages for simplicity. So guys, that's my first hour. Every day it's the same thing. It's the repetition. It's saying the same thing start to finish. It's giving you the rules. Guys, give me a Y if you can hear me, please. Thank you very much. And guys, if you ever can't hear me, tell me. Go, hey, Mark, I can't hear you, bud. And I'll talk to the room and I'll say, hey, can you guys hear me? And then you see this flood of Ys. That is your indication that it's coming from your end, not my end. And the easiest thing to do is to hit Control, Alt, Delete, and then kill Discord 100%. Then rejoin. And that almost always fixes it. It almost always fixes it. So give that a go. So guys, you've got the rules. You have the ability to simulate. I'll give you feedback every day on everything that you do. Post your pictures in your spreadsheet. And even more importantly, guys, with that spreadsheet, go back to it every morning. Go back and look at what you did every morning and ask yourself what worked and what didn't work, and begin to recognize these patterns. Go back to the feedback and see what I said about your trades, because you're going to begin to recognize a lot of patterns in yourself and in the market. And then now it's just repeat, rinse and repeat. The only thing that I can't give you guys is the desire to do work. The only thing I can't give you guys is the repetition, is the experience. So get to work a little bit. Ask for help. Be the squeaky wheel. And then every chart that I look at for the second hour, I'm going to go back to these 3 concepts, no matter what kind of trade it is. I'm going to go back to momentum, path, and entry. We're going to talk about it, recognition. If you win or lose, I have to tell you, it's absolutely no concern of mine. I like to see you win, I really do. But your money has never bought me anything pretty. So instead of telling me that you won, tell me that you followed the rules. Tell me that you're setting yourself up for long-term success. Tell me what you see. Every chart you post, describe momentum, path, and entry. Show me the trade from start to finish, and I will give you the best possible feedback that I know how to give. So, I'm a big believer. Breaks are important, guys. Get up, stretch your legs, go relax. I'll be back in 4 minutes. When I come back, we're going to start looking at pictures. Guys, crude oil still has momentum, still has path. There was the one bounce outside, and now we're starting to get another bounce right at the very base of those triggers. They're fighting. You're literally seeing the fight between buyers and sellers right here, but the advantages are up. Potential to break, pulled right back to resistance inside of triggers, but it's only the potential to break. If you chose to take this trade, your stop would have to be 1, 2, 3, 4, 5 ticks above those triggers. If they continue down to your first target, you'll go break even. Because it's only the potential to break, ladies and gentlemen, we may have to manage assertively. Does that make sense? There's your first target and the reversal bar. Let's go break even. Second target's at 200. Everything says down. Momentum is strong. Oh, they tapped it but didn't hit it. Let's see what they do. What do you think, guys? You just made $100 by following rules. You have zero risk on the trade. You're like 2 ticks away from profits. Come on. So close, huh? Let's get to where we can see our entries and exits. Text and markers. Congratulations, ladies and gentlemen. You just took a $300 trade with momentum, with the potential to break, and trading from the area where the market was most likely to continue. You guys are amazing. I'll see you in 5 minutes. Into that second hour, and all that momentum, it's still going down, isn't it? And look at this. If I circle the tail, it's a pullback. And if I circle the tail, it's a pullback. Pretty cool, right? So I'm going to scroll up to the top of the room, and I'm going to start clicking on the charts that were posted, and we're just going to talk about them. Joel got us going, little foursome there. And he's not taking trades, just annotating. And he says, check it out, Mark. I've got odds favorable momentum. And guys, just a heads up, I do these in order. If you need me to cover your charts because you have someplace to be, let me know. We'll go to it. Otherwise, I go in order. And I always do it after the rules because I want you guys to be able to create a little correlation. So Joel says, check it out. I've got strong triggers. Separation between the small and large, opening like scissors. It's only a 50-50. My smalls are through, but my large are not. I haven't reached the next area. These one-to-ones have the potential to break. Not a trade taken. No divergence. Entry inside of favorable large triggers. I don't know, Boaz. What do the trigger lines tell you? The trigger lines say, hey, guess what? It has the potential to break. Divergence says it's less likely to break. So Boaz, you don't know right now. You just don't know. You don't know what it's going to do. You do have rules on that KISS plan that said once this divergence prints, it's less likely to break. Does that make sense? Because this isn't a clear path, and now there's a loss of momentum. Oh my gosh, we're giving up 2 of the advantages. So yeah, it could still go down. But now there's not rules met, and not having those rules met probably just kept a lot of you out of a loser, I hope. Good question. So it's in that not sure yet. It's in that wait for the reaction time, Boaz. Next annotation, I like this. Joel just says, you know what? Termination conditions are the most broken rules among new users. Termination conditions are one of the biggest reasons people lose money. Let me take some pictures of them. Let me commit them to memory. I love that, Joel. Let me do it again. Because I don't want to get caught trading into an area that could stop the market. Nexgen shows me exactly where highs and lows could be. My trigger lines tell me whether or not I should be patient. And Joel, perfect pictures, spot on. And then doing it again. Weak triggers, why? Because the colors don't match. Strong triggers, why? Separation of small and large, open like scissors, rule 1 met. Guys, these are the kind of pictures that turn you into a chart reader. These are the kind of pictures that remove hesitation. These are the kind of pictures that set you up for success. All right, Cav says, triggers just got below the red fib. Took the trade, got lucky. I agree. You had a lot of momentum. And so, Cav, one of the things about this trade, are you with me, Cav? Guys, there's this trade called the chili dog. And the chili dog says, let price get past areas and then look for an opportunity. Cav, all you did is you jumped in. I mean, nothing is below that. Nothing is below that thing at all. It's directly into a termination condition. And then it's still pulled back and you held on, hoping that that termination condition was just a figment of your imagination. And sure enough, the momentum pushed it down for a retest. Super low probability, Cav. You knew that, right? Maybe you got bored. Guys, this is a tough look. This is nothing more than I hope it breaks. This is a trade that's reliant 100% on momentum, and momentum fixes some mistakes. So, Cav, I'm happy for your success on that one. And you're absolutely right. Kids, don't try this trade if you know what's good for you. Sometimes we take trades and after the fact, we're like, uh-oh. Maybe that wasn't my best bet. Maybe that wasn't my highest chance of success. Sitting on my hands drinking coffee. Odds favorable. No clear path. Not a strong bottom. Possible trade area inside of triggers, but not a clear path on the 5-1. Would have required some tight management, but could have been a base hit for a 375. Dangerous practice to get into, guys. My rules weren't met. But if I just would have broken my rules, I could have made $400. What you have here is a momentum style trade, Bob. Strong triggers, break the area, snap back. This is a momentum trade. This isn't a trend trade. And that momentum trade might have carried you up to the fib. From the momentum point, you had room to your target. Does that make sense? That's one of the more advanced trades, and you have to be able to see it really quickly. But the momentum rules say with momentum, smalls break, price snaps back to the fib, ride that momentum to the next key area. It did. It happened super fast, right around there. The NASDAQ did the same thing. The NASDAQ printed like 40 bars in 8 seconds. I looked away and I looked back and the market was up 30 points. That's a good read though. It's a good look. And another good one. Odds favorable. It's directly into those 1-to-1s. And guys, 3 divergences. This is the only time on a small chart where the small chart will talk you out of a high probability trend trade. 3 divergences in the same price range may terminate the trend. Let me go to, I'm going to go to the termination conditions section from the day trading guide. Guys, there's one time on a small chart where it behaves as a termination condition. This is the only termination condition on a small chart. 3 divergences in the same price range may terminate the trend. 3 losses of momentum in the same price range is telling you things the large chart can't because it moves so slow. And then that third divergence is higher. It makes a head and shoulders. It becomes even a little more powerful. And you nailed it, Bob. You said, whoa, that's an indication that things might be changing. Dark Horse, you're new. Welcome. Great to have you. Wanted to trade NASDAQ about 20 minutes ago. Kept getting stopped out. The order didn't even show on the screen. What am I missing? Is there a spread that I may not be accounting for? Can you show me a picture of the trade you took? That would help me so much more. And one thing you can do, Dark Horse, are you listening? You got your ears on? Guys, this is for everybody. Right-click on your entry chart. Go to Data Series, and down at the very bottom where it says Plot Executions, make sure that it says Text and Marker. And that'll show you where you got in and got out. But without seeing your chart, it's a little difficult to have an idea of what's going on. But that may be part of it. That'll show you your entries and exits at least. And you'll know what's going on. So if you'll post it in the room, I'm going to keep going through these pictures, but I will get to it. We'll talk about everything and see if there's any help that I could give you. Jeffrey Dean, odds favorable, potential to break, just focusing inside of triggers, gaining confidence on setting up buy sells inside of those triggers, setting your stop. So you got in on the pullback a little early, kind of in the middle. That's okay. You're focusing on it. And now it's going in the direction of your trade. You've reduced your risk. So Jeffrey Dean, the only thing I could say, brother, is why would you put your stop on the other side of the area that could stop the market? This is one of the great things about the accuracy of what we do is you know where the market could stop. You know where the bounce could occur. You know where that forward progress could end. Putting your target on the other side of it is really exercising a little hope. Right on. So you can always move those. Dark horse, unfortunately, you didn't get the image. You can go back and get the image. You have the markets on the oil chart. I thought the setting would carry over. No, it is individual for each. But you can scroll back and get your picture. Dark horse, people always tell me, well, I didn't get the picture. I can scroll back all the way to here. If I took this trade in the middle of the night, woke up sleepwalking, I could still go back and capture that picture. I could still go back and annotate that chart. So if you want a little help, and guys, I'm telling you right now, if you get stopped out, kept getting stopped out, let's look at it. Did you have momentum? What did your path look like? Where was your entry? So dark horse, scroll back. Put those markers on there. Let's get you some help. There's nothing more frustrated than losing a trade and not understanding why. Guys, you don't have to live in that state of frustration. All you have to do is post in the room and give me the opportunity to give you a little bit of feedback. So Jeffrey Dean, how did it turn out, brother? I love it when you guys show me entry because this makes you look like a badass, right? What happened? Show me the rest of it. That's what I want to see. The momentum is incredible. Right on. And then when it pulled back to support inside of those triggers, you got in on the way up. I like it. And you're looking to go to the fib. Black Princess is great. And your stop is still inside. So one thing about this trade, Dark Prince, are you in here? Black Prince, sorry. I don't think he is. Guys, this is a momentum style trade, which means that the small triggers break through and it snaps right back to that 1-to-1. Oh, there you are. Cool. This is kind of a momentum style trade. It doesn't actually have that pullback to an area. Does that make sense, Black Prince? I love the entry. Momentum, breakthrough, snap back. So on this particular look, let me do this. Because you didn't actually get a pullback. You got like a bar that didn't even form a down bar. This is the momentum trade that Nexgen teaches. And off of this trade, my stop is right below the bottom of that bar. And if they come back or I lose momentum, it's an exit condition. And if I remember right, it did lose momentum and then it pulled back towards that mid band. So this is one of the things that happens when you don't actually get that pullback to an area. It's a different style trade. It's what we call a momentum trade. And momentum trades are amazing and you nailed it and it's beautiful. Allow them to be lower risk. But once you can define your trade, once you can define that this is in fact a momentum trade and it's based solely on momentum, Black Prince, you can say to yourself, my advantage is gone when momentum is gone. And then absolutely, you can get out before the pullback, take quick profits, and then if it turns into a trend trade, outstanding. But that's a great read. Nice job on that one. And then if you're Ron in this room, Ron uses this exact same look to ride that momentum for quick profits in that trade that's called the chili dog. But you really did that one well. Is a good read. And then Wayne, good morning. And Black Prince, that's kind of it. Actually, this is a termination condition. And then from the termination condition, his small chart is showing him change that you don't see yet on the large chart. But since the small chart has all that momentum, Wayne just grabbed a quick little snippet of it. Just a quick little snippet of it. Grabbing hold of that momentum for quick profits. Wayne, nicely done. And then Cav, not to the termination condition yet, but you're trading into that fib at 97. It's not showing over here for some reason. Momentum, momentum. Trading into the fib instead of below the fib. And it's not a 50-50 trade, Cav, because you just jumped in. The 50-50 would have been a pullback up here, but that was all the way up here. This is your 97 fib. This is your 97 fib. You traded directly into the termination condition again. You're showing an arrow on the other side. But you're in over here. And just that little bit of patience, Cav, that little bit of patience to get to the other side of trouble, it's gonna help. It typically does. And then you feel better about holding that one down to the fib. And you're making money, so I'm not going to argue it. But I have to point out that you're trading directly into termination conditions. That's 2 for 2 today. And eventually that luck runs out, I think. And then Ron, and then Black Prince. This is where Ron even told you, hey, Black Prince, great chart read. Let price clear trouble, getting away from the fib. And then that was your exact same entry, Black Prince, 100%. And notice that he's only taking short profits on a trade that is 100% momentum. Took this as a chili dog, but it ended up being somewhere between a trend trade and a next-gen momentum trade. Black Prince got this pullback to 72.69. Good read. I love that. What a supportive community. But do you see how he got out quickly? I think that's the best lesson I could give you. Is when the only thing you're relying on is momentum, be okay taking small hits. Be okay grabbing $100, $110, and then wait and see what happens. See if it turns into a trend trade. Ron, great trade, great lesson. It's fun watching a couple of you guys taking the exact same entries. All right, JR, can you hear me? It takes a second sometimes, Dark Horse. JR, are you in here? Can you hear me? Not in here anymore? So guys, this is a great example, and forgive me if this seems harsh. What am I supposed to do with this chart? Hey, Mike, welcome to the room. I don't know what we're asking. I don't know why there's an order below everything. I don't understand how this fits into a plan. I don't know what you see that makes you want to enter here. And that is a sell, stop limit, market if touched. So why do you want to sell the market down here? Everything's up here, you want to go down here. Everything's up here, you want to go down here. Everything is up, you want to go down. But did you notice that you would be going down right at a fib? So guys, when you post in the room, I want to see everything. But I want you to tell me why. If all you do is show me this, I don't know what you're thinking. I don't know what your chart read is. I don't understand why you would want to take a short trade when everything on God's green earth says up. Give me a little insight to what you're thinking. All right, Jen, there was that first one. Odds favorable, potential to break. You get in on the correct side. You get out right up by trouble. Beautifully done. When it pulls back, this would have been a trade too, but you did miss it, and that's okay. Sometimes we miss trades. That's just not your money. Great trend trade, easy money, and then pointing out the next trend trade, so hopefully she can catch it. Great job. All right, Tracy giving me a twofer. Let's see what you got, Tracy. Good bottom. I like it. Price reaches, no triggers crossed, fib, triggers rolled up. Isn't that called the edge of a fib since there's multiple? Yeah, or just a termination, Tracy. It's a termination condition, but it is the edge of fibs. I haven't heard that term in a while. But yeah, it's the furthest fib, but it's actually two termination conditions. And then when it all rolls and heads up, you find a great way to capitalize. And I'm trying to get the prices here. I'm not sure, 814. So you're probably in somewhere, no, because everything is up. So you're in somewhere right here. Is that right? On that little snapback, I can't see the prices. Yeah, but I can't see the prices on your large chart. So it looks like you're getting in before trouble with momentum on the way up, and you get out at trouble. And then you've got odds favorable momentum and a clear path, and you really hold that one. And did you notice that you exited right at the area, right at the triggers, with odds favorable momentum and a clear path? That's the one lesson that I want to give you on this one, is you put your stop exactly where the market was most likely to bounce and continue with the trend. Does that make sense? Everybody in the room. Because pretend like you didn't have that stop in place. You had odds favorable momentum and a clear path and a pullback directly to support right there at the triggers. So you wanted the profit. I don't disagree. I want profits too. So check this out. I'm gonna give you a little something out of the old noggin here. Your trade is a momentum trade, right? It's not really a trend trade. Everything is momentum. Is that right? I just want to make sure that we're thinking the same on this trade, because I've got some good stuff for you here. So if momentum is my Y, loss of momentum is my exit. Does that make sense? So every kind of trade you take may have a little different management plan. So this would be your loss of momentum. That first close on the wrong side of the triggers. I'm going to show you a cool picture, Tracy, and this will help. So if the only reason I'm in this trade is because of momentum, and that's okay. I'm a huge fan of that being the only reason, momentum and path. A close on the wrong side of the trigger lines, Tracy, this signifies a loss of momentum. And you don't know if it's going to be a 2-bar loss or if it's going to be a 10-bar loss. So any momentum-based trade that I'm in, this is my exit. Once I close on the wrong side of those triggers, that's my exit. And if it doesn't happen, check it out. Bounce, 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 bounce. So your exit could have been right here. You could literally have a stop on the reversal bar marker. And then when you got down here, if you wanted to re-enter, Tracy, because the rules were met, hell, you're going to double dip. Don't give it back. Make it back over here. And then here we have the potential to break. It looks like it stopped printing on yours. I think a lot of people had 1-to-1s there. Let's take a look. Strong top, price hit, triggers didn't cross, large, absolutely strong top. Would this be a 50-50 or high probability trend trade? Smalls have crossed the support, but it quit printing, and then the larger barely across resistance. So on your chart here, Tracy, that's a high probability look. That is momentum and path. That chart that quit printing at 8 a.m., that's the fib update. This is a good look. That's a good look. And it hit your first and then stopped out break even. Yeah, that's a perfect look. Perfect entry. And even on a trade that failed, you were able to get out, break even on the second contract after making money. Great management, Tracy. Nicely done. I like it. Beautiful trade. And then I think a good lesson about as long as you're left of those triggers, it's going up. And once you get to the other side, you don't know where it's going to stop. So 2 good lessons there. Nicely done, man. Great trading. Remember, new users, you're always welcome to ask a question about anything you see. Doesn't have to be your chart. All right, Jen, bad bottom, odds favorable. Enter just above small, way above the small. NASDAQ is fast, isn't it? Look at that, 10.15, 10.15, 10.15, 10.15, 10.15. There, it finally went to 16. Jen's entry is a close on the correct side of the triggers. She got slipped 5 bars, but she still had room to her target. Beautiful. And then she held it. There's that loss of momentum. Jen takes her exit, and of course they bounced up a little bit. Stopped out second at break even. That's not break even, Jen. That's a 50-50 trade. Smalls are above, large are not. She's in right here. Out at a fib. Oh, yours is a 50-50 trade. I'll be right there in a minute. Remember, I got to go through these in order. Steve Diego. Let me see which way we're stacked. Okay. Guys, this is that peek through that I talk about. When I say smash, when I say price smashes through an area, guys, that's not it. Small triggers didn't break. So directly into a termination. Beautiful entry. And I love it. Talk about quick profits. Making something out of nothing, Steve. And then odds favorable, strong bottom. Target was the fibs, but less than 2 minutes before the open. You take the little pullback. It doesn't hit your area, so you get in on the up bar. I like it with all that momentum. And then out of trouble again. Great trading. Great trading, Steve. All right. You made a quick scalp on this trade. So I'm glad you made it. Can I do my chart read? And I'm not dissuading you from doing whatever makes you happy. Dark horse, NASDAQ takes a little bit depending. Give me 1 second, Steve, because this isn't in the moment question on 50-50. I'll get back to it, I promise. I got it. It's already pulled up in the lineup. The question is this a 50-50? So that goes back to basic rules. Black Prince, every time you look for something, if price reaches an area, triggers above, it's a termination. This is not a 50-50. 50-50 means that 50% of your trigger lines get through, 50% are not. Does that make sense, Black Prince? This is a textbook termination. You sold right into a termination. And these are the things, so look at this. Termination creates a bounce. Termination creates a bounce. Blue fib creates a bounce. Red fib creates a bounce, right? So Black Prince, do you really have to hope? It's okay to let things break. It's okay to sit on your hands. It's okay to relax. And yeah, you're kicking a little ass today, but is trading into areas going to serve you well every day? Is trading into termination conditions going to win more than it loses? I can tell you that the answer is no. It's not going to win more than it loses. That's how rule number 2 came to be. So even though you made money, Congratulations on making your money. Short-term victories very often set you up for long-term failures because you are void of advantages. And then just to compound with those large triggers all the way up here, price is way more likely to suck back to those than it is to go through this fib. Good lesson. Not a 50-50. Textbook termination. Steve, termination. Nothing but trouble in your way. You trade directly into the trouble and you get paid. You're welcome. And it's never me going, dude, you're wrong. It's me going, hey, guess what? We could probably do this a little better with a little higher probability. That's all it is. Please don't ever take feedback as a negative, anybody in this room. Because watch this. Not a strong bottom because nothing reversed. Guys, this is a huge downtrend that's having an untradeable bounce off of a termination condition. That's it. It's a huge downtrend directly into a termination, creating an untradeable bounce directly into termination after termination after termination. So Black Prince, you tried to go short in the same look, right? Steve said, if my triggers roll off that termination and I get momentum, I'll give it a shot. And that's exactly what he did. Steve, you fought everything on God's green earth on this trade. Your small chart gave you just enough giddy up, and you were aware that it wasn't a high probability scenario, and you got paid. And it was the small chart momentum from the large chart termination. It was a beautiful combination of chart reading that lets you fight everything and pull it off a little bit. 3 divergences didn't hurt. Good stuff. Probably super low probability. But I'm glad you got paid. So, Prince, you're asking, is the next fib a termination as well? Where did your picture go? Is that what you're asking? Is the next one a termination as well? It is. The size of the line doesn't matter. So on your large chart, well, Steve, I think you gave yourself the best chance. And I'm not beating you. You had the termination and your small chart gave you a chance and you took it and you managed it aggressively. So not the highest probability, but still you did it well. All right, so on your large chart, Prince, you have Fibonacci from 3 time frames. You have the native time frame, the 13.2, and these will extend all the way to the right. So no matter how much gray is here, you'll always see that fib. You'll have the skinny lines that don't continue printing, and they will stop right behind the printed bar. And it doesn't matter. This is on every large chart, every market. And then you'll have the big fat ones. And these are from an even higher time frame. So that's from a 21.3. So you have 5.1, 21.3, and 13.2 fibs. They are all equally as important. 100% equally important. One is not stronger than the other because look at this. The 21 stopped the market cold. The 5.1 didn't break, and then the 13.2 fib is what stopped the market. So it's not the size of the fib that is any concern at all to me. What is the concern to me is that simple recipe for defining a termination condition. Hold on. And it's the same no matter what. In order for it to be a termination condition, price must reach the area. If price never reaches the area, Black Prince, it might be a target, but honestly, it's just a blue line floating in the middle of nowhere. Does that make sense? That's just a blue fib. Until price reaches it, it's just a blue fib. But once price reaches that fib and the triggers don't break, now it's a termination condition. The same way this was just a red fib until price got to it, and then it became a termination. Hell, this was a target until it became a termination. This is defining where the market is likely to go. And then once price gets there, it's defined as where the market is likely to stop. So on the way down, these fibs are where the market was likely to go, and once price reached it, it becomes a termination. And remember, there's going to be times where you can't get a clear path because they're stacked a little bit. Great questions. I hope that cleared it up. Andy, where's your large chart? You're killing me, Andy. Andy's like, I'm going to make Mark cross-eyed every chance I get. Odds favorable. There's his little pullback. There's his pullback here just above the 1-to-1s. You're welcome. And Black Prince, I'm so excited to see you participating in class. Let's do this every day until you just run out of questions. And guys, this is for everybody. There's so many times where getting clarity is such a simple process. Just do it. I love it. Everything says up with strong triggers. Andy says, I'm going to take a little snapback to those 1-to-1s right inside of triggers, and I'm going to get paid on the way up. Andy, great trade. Nicely done. Then Boaz. All right. Is it a 50-50, Boaz? Your triggers didn't break. No. And you're trading the NASDAQ, which means these pink 1-to-1s are a termination condition as well. NASDAQ, your large chart is a 34. So you have a termination condition. 100%. That's the me, let me go back to the basics. Look at the momentum. It's outstanding. Look at the entry. It's pretty low risk. And look at the intelligent exit right at trouble. So Boaz, if you're going to trade into a termination condition, you couldn't have done it any better. And the only reason I say it, and the fact that you called it a 50-50 meant that you had your management hat on. And if something changed during this trade, I can't talk today. If something changed during that trade, you would have been prepared to manage because you identified it's not perfect. Well done. I like it. And then for you guys using market flow, Boaz, did you notice that you had odds favorable momentum here as well? Just kind of helping with those advantages. I love it, man. Great job. So for you newer guys, Gary and Hayes, this is what we do every day. We talk about some very basic rules, how to identify them, and then we just go to you. And we let you tell us all the great things. So let's see what we have. Odds favorable, clear path on 1 and 2. You try a little momentum and it doesn't work out. First entry. Coming down below the 1-to-1, I agree, but your price is still sitting on the 1-to-1. So your price, Wayne, is still sitting at that area that could make a bounce. And it did. It made the bounce, and then it headed back down. And then they just decided that they were going to push up. And this is one of those things. If I'm in a momentum trade, I'm willing to take a little hickey, give up 3 or 4 ticks when the momentum is gone instead of giving up all of that money. And then you get back in on the way down and you hold it because the large chart leads the way, out at potential trouble, and then it comes down, you're breaking through, pulls back, you don't trust a mid-band outside of triggers, so you force it to go through it and back down. Wayne, I love this entry more and more every time I see it. The more I see you execute your entries, the more I'm like, man, I like it. You let it break through, And then because it's not the perfect entry, it's outside of the triggers, you said, I'm going to make them go down. I love it. And then you get paid. Great job, dude. Great trading, Wayne. Boaz again. I mean, just as sexy as all get out, though. You said you missed it? Sometimes we do. Man, that's a great looking trade, though, isn't it? Why do you feel like you missed it? Because it had odds favorable momentum. Because the path was still clear. Because it pulled back to support right inside of those triggers. I mean, great googly moogly. You can't set it up better than that. I want the world to see your trade here, Boaz. I want my new users to be able to come back and see that pattern and say to themselves, sells. This is Boaz's perfect high probability trend trade long. Whether you got it or not, that's a pattern I want to study because it's perfect. Beautiful work. No? No, you didn't get... You weren't in the trade. Did you doubt it? So can we cover that? Can we turn this into a lesson? Did you not believe that the rules were met? Is that why you missed it? Or were you away from the computer or doing something else? You saw it late. So if you weren't there to catch it, it just wasn't your trade. Right? Like if the market's doing this and Boaz, I'm like, oh my gosh, I gotta pee. And then I come back and the market's right here. Guess what? That's just not my trade. I didn't miss it. I just wasn't there. It's not mine. But you know that if you were sitting in front of your computer, you would have taken it, right? Without hesitation, you would have been in just above that mid band and paid at that fib, 100%. I love that you went back and circled it and said, man, even though I don't catch them, guys, this is one of the things. You may not catch every possible trade, but if you do this, you know that there was the potential for, oh my gosh, from, we'll just call it 85 to 97, 12 points, right? $240 per contract. So Boaz, you know that that could have been your trade. You know that it fit your rules. You know that it's your pattern. That was an expensive cup of coffee. But here's the question. Will there be more? Will there be more opportunities? The answer is always yes. And when you trust the patterns and you learn the software, guys, you believe that. And when you believe that there will be more opportunities, you don't feel the need to trade into termination conditions. You don't need to take trades without strong triggers because you know more trades are coming. Jen knows there's more trades coming. Odds favorable, 50-50. Nope, right into a termination, Jen. We just had that talk on someone else, right? Directly into pink 1-to-1s, absolutely no triggers through. Guys, if you are a NASDAQ trader, pink 1-to-1s are a potential termination condition. Pink 1-to-1s can stop the market. Pink 1-to-1s can create a reversal. Pink 1-to-1s can create a bounce. And Jen, that bounce took you right back to areas inside of triggers. So if you were going to choose to take this trade, that mid-band with the small triggers a full bar away was the best entry. You got the second entry. It gave you a third opportunity. And then it went all the way up to your target. Guys, the only market where those pink 1-to-1s are a termination condition is the NASDAQ. But Jen, I think Boaz took this one. If you're going to trade into a termination condition, give yourself room to manage back to that termination condition. You had room. You gave yourself enough room to react, and you're on the good side of the triggers. You were actually in late. But you still had room to manage, and that's the key. Having room to manage. If you're gonna break a rule, if you're gonna take a chance, have room to manage. Know that you need to manage. Odds favorable, clear path, perfect entry, beautiful exit. Why did you have the wrong ATM? That's an outstanding exit, Joel. Man, have fun, Ron. We have snow on the ground here. My front lawn is covered in snow right now in Austin, Texas. Stupid Austin, Texas. Joel, it's beautiful. You're in at the area. You're out at the area. I mean, that's outstanding. It is. I mean, it's not a lot of snow, Jen. And it'll be 75 degrees. Take care, Cav. I'll be golfing by Monday. All right, Wayne. Odds favorable. Clear path. Perfect entry. Damn it, it didn't work. So the only thing I could say on this, Wayne, I mean, everything is perfect, dude. It is the greatest trade ever, the perfect entry. The only thing you could have done is put your stop 2 ticks above and maybe saved 40 or 50 bucks. Does that make sense? Using that reversal bar. Did you? That's the only thing I can see. I mean, that is the perfect trade that just didn't work. And man, that's one of those ones too where, you know, when we're talking about setting up the new users for success, that's a great loss. Oh, let me give you credit. Put you in the Hall of Fame. But yeah, it's a good loss. And even on the perfect trade, the only feedback I can give is if you use the reversal bar to reduce risk a little bit, you end up giving up maybe 3 or 4. Black Prince, I will comment on everything. I am a gum flapping guy. You can do whatever you want. How's that? Mark, can one put a sell stop below a fib area anticipating a breakout? Of course you can. Go right ahead. But where will you put your stop? Where will you put your target? What will your exit conditions be? And what if I put my entry, Black Prince, 4 or 5 ticks below that potential termination condition in case of a breakout? How far do you need it to break out? Same thing here. How far do you need it to break out for it to be considered a breakout? Price reach Fibonacci resistance or support. I've got 2 divergences from the exact same location. So, I mean, Black Prince, the great thing is everybody can do whatever they want to do. But how do you define the breakout? How far does it have to go? Are you using price or are you using triggers? And I asked that, and I love the question, right? So let's just look for some examples. This is probably a pretty good one. That's 5 ticks, right? Small triggers are breaking through, large triggers didn't. if I said, okay, I'm going to trade the breakout right there without the clear path, it didn't work out for me. So things that I would think about if you're going to do that, and this is a key for me. If I'm just going to arbitrarily jump into the market, Black Prince, the old JTFI, the one requirement that I'm going to have is strong triggers on both charts. Does that make sense? So I'm not saying don't do it, but if decisions can be made right here, don't I at least want to have the strongest triggers ever coming through? I think the answer is yes, but that's up to you. But man, there's those termination conditions again. And look how powerful they are. Yeah, they break sometimes. So Ron's trade, let me go up and scroll to Ron's chart. Black Prince, you'll like this because I think it's going to appeal to your desire to catch the breakouts. So one thing Ron does, and he does, he catches these breakouts. See how he does it? Just jumps in, giddy up. I'm going to show you kind of the principle of this, and let me know if it makes sense. And this is what they call the chili dog. Because it's quick profits based on momentum, it's enough to buy a chili dog. And I don't know that you guys have those where you're at. So this is the fib that could be problematic. Is everybody with me so far? Do you guys remember the idea that decisions are made at key areas? So I want you to see this. At a key area, there's one of those tails. It means there was a bounce. There's one of those tails. It means there was a bounce, there was a bounce, there was a bounce, there was a bounce, there was a bounce. Right at these key areas. So Black Prince, if you want to trade the breakout, one of the things that you can do, and this is what Ron does, and what he taught me, is let price completely clear the area. Force price to clear the decision-making area. Does that make sense? That means that the back of the bar clears the fib. And this is something this is a Nexgen user taking his ability to read indicators. This is not a Nexgen trade. And he does the same thing over here. He says, these areas can create bounces. Let me let the back of the bar clear it here as well. And then Black Prince, what he does is he takes quick profits based only on that level of momentum. But he forces price away from that decision making. And then Bob B, and then Black Prince, please take this one as well. I did 30 days of study on the chili dog, and I just dropped my document in there of kind of what I came up with. And the document starts with Ron's. It gives you a little bit of a checklist here. There's your management. Hold for 110 profit, 7 ticks. It's really fast. Focusing on the large charts. Here's some pictures. And I even put some pictures in here what it looks like when the rules aren't met, because I made a lot of mistakes learning this trade. So guys, feel free to steal that. Look at it. And Bob B, that's got management in there as well for you. And there we go. There's a great example of why we respect termination conditions. Even with odds favorable momentum. The skinny fib is the one that stopped the market. Pretty cool, right? So right now we're in a holding zone. Large triggers down, small triggers up, termination above me, termination below me. That is a go make a sandwich pattern. The S&P though has a termination that reversed the market. We're on our way to strong triggers, aren't we? Smalls are starting to break above, the large are up. If I look to the right, there's a retracement zone if I get a reversal bar. And inside of that retracement zone, I've got areas. And if I took this trade, I know right where my stop goes. Do you guys see it? That's how quickly your analysis will happen. Termination reverses the market. I'm starting to get the smalls to break above, so it's not the best, but I have a clear path, and I've got areas inside of triggers. And if this market is going to retrace and bounce, that's where it's most likely to happen. Can you guys give me a why? All I did was run through that checklist. Now the momentum's even better. Oh, it just keeps getting better. And now all I'm thinking is, for the love of fuzzy, give me a pullback to an area inside of favorable large triggers. Give me a reversal bar. Give me a reason to enter that highest probability trend trade. Steve Diego, everything says down. You hop in and you hop out. There you go. When you have momentum and room to a target, guys, there's that quick path. Steve Diego, nice trade, man. Nice trade. Wow, we made it through the second hour, guys. Great job. Oh, son of a gun. They hit a termination condition, didn't they? Price reached a divergence high. All of my triggers are below. I've reached an area that may stop the market. I have to make a decision. What do I want to do with that? Do I want to say absolutely no trades? Do I want to say I'll give it a shot? Manage? That's up to you. Only you can answer that question. Guys, I'm going to take just a couple minutes. When I come back, the rest of the classroom is 100% dedicated to you. Andy, I will start with your picture. I'll be back in about 3 or 4 minutes, guys. Robert, don't need answers now, but does the manual define these? Where can I study these? The chili dog trade is not a Nexgen trade, Robert. Nexgen has absolutely no affiliation with it. It was designed by a Nexgen user. But if you scroll up in the chat box about 6 inches, you'll see my study on it. You're welcome to look at it. The user guide, 100%. 100% has the answer for all of these. The videos has the answers for all of these. The ATM for each trade is up to you. The KISS plan that I give every morning has the answer for how to place stops as a new user until you have the ability to do it. But right here, and I'm going to give you the link, this is all the answers, Mark. But can I say something? Can I add something to that? Reading all this stuff is awesome, right? But Robert, Mark, whichever it is, you've got 15 hours live every week to ask me a question about anything you want to ask me a question about. You have 15 hours live every week to get the feedback on everything that you do. You've got all the answers right here. And if you go to the YouTube page, you've got 10 million videos to confuse the hell out of you. But we've got a classroom designed to give you everything that you need to be successful with 3 little rules on only 2 charts. And then you grow from here, and the rest of them kind of come in. But the 50-50 trade is just a high probability trend trade without a clear path. The momentum trade is in the user guide. The trend trade is discussed every day. It's in the user. Market flow, how to use the analysis, when to use it. You've got all the market flow section right here. You've got entries, opportunities, And then the ATMs are set up. That's going to go under management, understanding trade management. And there's a whole video dedicated to it. Oh, right on. No worries. So let me give you something for a foundation. And that's cool. You're working on your PhD. I know how much work that is. So this document right here, let me streamline it for you a little bit. Because there's a million ways to use the software. There's one way for the newer users to get the absolute best results, and that's that trend trade, that high probability trend trade. And that document that I just dropped in the room breaks it down into 2 pages. And then there's a plan that gives you the best case scenario for both the trend trade entry as well as the 50-50 entry. I would encourage anybody that's brand new, become good at those. Get good at those 2 things before you start looking for every opportunity with this software. Does that make sense? It's kind of like you're working on your PhD now, but your freshman year of college, that PhD just would have confused the hell out of you. And that's kind of what looking for everything does in the beginning. So hopefully those 2 will streamline. And then Robert, just because it's important to me that nobody gets left behind, there's my email. So I get that you can't be in the class that often. Don't be afraid to reach out if there's something I can help you with. There's nothing worse than feeling like you're not getting the help you're needed just because you can't be in the classroom. So please feel free to use that if there's something that I can clarify for you. I don't check it. It's not on my phone. But when I'm at my computer, I check it randomly throughout the day, and I will always reply. I will always reply. But guys, I've got to take 5 minutes to stretch my legs. When I come back, ask a million questions. Absolutely. Ask a million questions. I'll see you guys in just a minute. So a classroom, get all your questions answered. Wayne, let's see what you're doing. Odds favorable, 50-50. Snaps back right to the support inside, and you get in on the way up, and pretty easy. Never moved your target from 110. Got a huge slip. Yeah, you did. 46.9, 46.9. I'm not even sure you got slipped. It just didn't even register. That's crazy. That's a fast moving market. Nice trade though, Wayne. Really great looking trade. Momentum and path. Guys, can you see my screen? Can you give me a Y if you can see my screen? See me moving the mouses? All right, so Boaz, what I'm doing is I'm making sure that it's you, not me. Maybe hop out and hop back in if you can't see. Refresh. It's up for everybody else. Anytime I get a challenge, guys, I just say reboot. Come in and come out of Discord. I haven't figured out why computers have troubles with it every now and then. But almost every time I have a trouble with it, one of the easiest things to do is hit Control-Alt-Delete and go to your task manager. And from your task manager, hold on, let me pull that up, see if I can slide it over. From your task manager, just kill Discord. Hit that, end the task. And a lot of times when you come back in, everything kind of works out the way you need it to. There's that termination again. Worked out great. So guys, what would you like to talk about? We got a few minutes. What's on your mind? What are you working on? I saw it. We talked about it, Andy, the long trade. Oh no, I did miss yours. Hold on. I'm sorry. Got it. Thank you for that. Thank you, thank you, thank you. Large charts. Had weak triggers. 3 divergences in the same price range, so you get in with a little bit of momentum and took the runner off when it got to the other side of triggers. Great job on the momentum, Andy. Momentum on 2 charts, you rode the momentum until it was done. What a concept. Beautiful trade, dude. I like that. Sorry, guys. I guess I'm drinking today. Jen, everything says up with momentum. There's the potential to break. Jen, I think your only focus and this will take time on the timing, right? So guys, this is a NASDAQ thing. This is your area for entry, right, Jen? That's your window of opportunity. So maybe a little work on but are you building confidence? Or are you creating a false sense of security? And let me show you what I mean, and you can feel free. Fight me on this. I don't mind. Doesn't it make more sense on a medium probability trade to have less risk? To have more room to make money? Because normally, if you had entered right here, you would have put your first target at that divergence high, wouldn't you? I know you're trading well enough. I know you're trading well enough to know that you would have taken profits at that divergence high if you had entered at the area inside of favorable large triggers. I don't know what your rules say about 50-50s with divergence. So what happens is if you get in down here, you have room. You have room to get to trouble, right? Instead of trading directly into trouble. So I love your trade. You're in on the right side of triggers. Everything is strong. Your targets make sense. But one thing I promise you guys is if I see a better way to do it, I'll talk to you about it. That's one of the beauties. And Jen, I think it's just that idea that when the small triggers are this far away, it's just a better entry. Down here. Oh, I know you do. I know you do. And it's just a NASDAQ thing, and it doesn't guarantee a winner. But I think what happens, or even with the reversal bar, right? Because then your risk is established. So I enter all of my trend trades, Jen, with a reversal bar. I can't tell you the last time I got in at the area and not a reversal bar. Because with this look, the reversal bar gives me room to the target, and it establishes risk. I can't tell you the last time on the NASDAQ I entered without a reversal bar. Maybe one thing that would be cool that you could do is just go back to today. And your large chart reads are always great. Your large chart reads are outstanding. Maybe that reversal bar is the compromise between the two. As you develop a little comfort and acclimation, just look at it. I don't know if that's the right thing for what you're doing or not, but I know all mine come through. Yeah, you're welcome. So for you guys wondering what the hell Mark's talking about, on the NASDAQ, if you're a NASDAQ trader, because the size of the charts are so huge, there's really two ways to enter a trend trade. Because every time you reach the area inside of favorable large triggers, and guys, I blew out a lot of accounts learning this lesson for you. Every time you reach the area inside of favorable large triggers, the small triggers are either going to be below the reversal bar marker or they're going to be above the reversal bar marker on your small chart. That's it. It's going to be one or the other. When they're below, waiting for a close on the correct side offers the highest chance of success. When they're above, getting in at the area gives you time to manage if they hold. Just a little something. It's in that spreadsheet. You can look at it. So I like minimizing risk. Huge fan of minimizing risk. Show you guys a cool little pattern here. When price reaches Fibonacci and the large triggers are below the reversal bar marker, this is what we call the gap theory. I think so too, Jen. I think you do such a good job of getting in the correct trades, letting the large chart lead the way, that you'll find you can be a little less stringent. I don't know what the word I'm looking for. You can be not so conservative. Yeah, because your large chart leads are so stinking good. And when the large chart leads the way, it's just an entry chart. You're just finding a way to get in. So, guys, anytime price reaches a Fibonacci area and the large triggers are at the key area. Pretty cool, right? Whoa, I just lost my connection. You know, Nexgen's plan's been consistent for the last 20 some odd years. I'm back now. Yeah, my connection blinked. I heard Ninja Trader tell me. Sorry, is everyone good? You got me? I'm back now. Define your termination condition. That's it. That's everything. Market's going up. Define your termination condition. If it holds, if that termination condition is true, the first trade coming off of it is what we call an HVA trade, using a breakout bar and a pink line to sell that market real close to the fib. And then from there, if everything is strong on all your charts, buying or selling a pullback. And guys, it's just rinse and repeat. From a termination, HVA trend trade. Keep taking trend trades if the rules are met until you reach the next termination condition, and then wait for the reaction. If that support breaks, go back to trend trading. If it holds, look for your HVA, and then if everything is strong the other way, look for trend trades until you reach the next termination condition. Guys, this has been Nexgen's plan for about as long as Nexgen has been in existence. There's the 2004 trend trade. Trend trade off the mid band, close below the triggers, take it down to Fibonacci support. That's 2004. The momentum trade from 2004. With momentum on the chart, let it break 1-to-1s, snap back, continue down. Fibonacci holds, let it roll, sell a pullback, mid-band's your first target. We've been doing the same thing forever because it works. And all you have to do, my Ninja Trader said it was panicking. Don't panic, Ninja Trader, you're just fine. There we go. Been doing the same thing because it works. Because it's an edge, because it's a pattern that's been proven to win more than it loses. And that's all trading is. And one of the things that you'll find is that the most successful traders, the most consistent traders, the traders that seem to be posting the most winners, if you look at their winners, they all tend to look the same. Their management plan seems to be the same. They seem to be very consistent, not in their focus on profits, but very consistent in the execution of the method, because the method has been proven to win more than it loses. So this is from Mark Douglas, absolutely brilliant in trading psychology. He's no longer with us, unfortunately, but John Novak and Mark Douglas worked together a lot back in the 90s. They spoke almost every day. And this is one of the most truthful statements that I've ever seen. When you stop expecting to win every trade, you start winning most of your trades. And when you stop caring about the results and you focus on the execution, that's that path to success, guys. And that's what Nexgen teaches every morning is here's the pattern. This is your flawless execution. Let's keep doing it until we can do it into an intuitive state where we don't even have to think about it anymore. And that's kind of what we do every day. Mark Douglas is amazing. I could read his stuff all day long. All day long. I'm just going to start sharing stuff since there's no questions, and then we'll end it at quarter till if that's what we need to do. We had a gentleman, he's been with Nexgen for 20 years now, and he knew that rules were the lifeline. Back in the day when this was called the pros room. And guys, there was a time where you could only get into the pros room if you worked your way out of the rookies room, if you posted enough. Awesome. Black Prince, have a great evening there, and we'll see you tomorrow. But as he was becoming a day trader, he realized that it was the flawless execution, that he needed to make sure that he was following his rules and executing his plan. And he built this, the penalty box rules. Maybe he was a hockey fan. But anytime he missed a good entry, not because he wasn't in the room getting coffee, but because he second-guessed. He knew the rules were met and he chose not to take it because of an opinion. He would stand up and walk away from his desk for a minute. He would set a timer and go. If he entered late, it was 2 minutes. Exiting for no reason, 3 minutes. Moving a stop to lock in profit in the middle of nowhere, not at price action. That was a 5-minute deal. Exiting late and giving up most of the profit. Ignoring the advantage going away. That was 7 minutes. Fighting the trend was a 10-minute penalty. Fighting a termination condition was a 15-minute penalty. After he studied termination conditions, he realized that it was such a huge advantage to respect them and such a disadvantage to trade into them. 15 minutes away from his computer. And then if he fought direction and the areas, that was it. He was gone for the day. He had to go do something else. So maybe create your own version of this. What's your thing? What's your biggest thing? My biggest thing was trading into termination conditions. So my sheet would be trading into a termination condition. You have to shut down and walk away for a minute. You've got to go text your wife or pet your dog or do anything other than get back into that market when you appear to be in a mindset to break your rules. Time to walk the dogs. No clear path, no momentum. Yeah. Jen, I hope your weather is better than mine. Pet the dogs for me. We'll see you tomorrow. Yeah, it's crazy when you get snow here. It was a dusting. I'm hesitant to call it snow. It was a little bit of white precipitation. Awesome. You're doing amazing. We'll see you tomorrow. It's just stuck. Guys, remember it's FOMC day. We talked about that this morning. It's not uncommon for the markets to come to a grinding halt before they start talking about what they're going to talk about. Jen's chart just showed it. The S&P, well, the S&P is working its way up, huh? All that indecisions, not uncommon for FOMC day. So, on divergence, what does the percentage actually mean? It doesn't help with identifying a strong top or bottom. Great question, PJ. The negative number, Steve. So the negative number, PJ, is just a byproduct of the calculations that your software runs. Let me see. So what happens, my MACDs aren't the way I need them to be, is your software uses a MACD indicator, which is just a momentum indicator. And as price moves, it runs this comparison. And that's one of the reasons why you'll see price fluctuate. That's useless. You'll see that white number fluctuate back and forth as it is deciding whether or not. And it's just it's a byproduct of the calculation. And the way that it was taught to me was think of divergence as being pregnant or not pregnant. If this blue line prints, you have divergence. And you can't have a lot of divergence. You can't have a little bit of divergence. You can't have a strong divergence. You can't have a weak divergence. It just is. Does that make sense? So that negative number is just a byproduct. And then a strong top or bottom has nothing to do with divergence. A strong top or bottom has been, and always will be a termination condition. Now that termination condition can happen at a divergence line, but when a termination reverses the market, It's a strong bottom. Divergence doesn't add strength to it. The negative number doesn't add strength to it. If it's first a termination that creates a reversal, that's the recipe for that strong bottom. Good question. So identifying strong tops or bottoms is just identify your termination, use the recipe, price reaches, where are my triggers, and then if the large triggers roll, it's a strong bottom. And check it out. See how the triggers got through this termination condition? Because the triggers get through, this wasn't a strong bottom. And that gave us a little indication that they may fight one more time. And then that key area stops them cold and reverses. And that's what set it off in the direction. Pretty cool, right? Weak bottom, they try it again. Strong bottom, giddy up to the north side. And you'll see that a lot in those strong tops and bottoms. You'll see like a weak top and continuation to the key area. You'll see a weak bottom and continuation down to the next area. So great question, man. Appreciate that question. Yeah, Steve, you're close to the border down there. I always forget that Tijuana is so close to San Diego. Boaz, the volume's low today. So, and I don't pay attention to what the daily volume is. I know some of you do. If you know that at 2 o'clock, the FOMC minutes are coming out, and those FOMC minutes are impactful to a lot of institutional traders. Sometimes they'll jockey for position to try to get into the best position for the direction they want to go based on the news. So you'll see a lot of fluctuation in the market before. You'll see the volume drop because people are just staying out of it and they're waiting. They're waiting for that key news release before they make a decision. So it's not uncommon, Boaz, to see lower volume, to see indecision, to see a lot of fluctuation on an FOMC day. It's the same way with crude oil inventories. 30 minutes before crude oil inventories, the market is either crazy or stagnant, waiting for that response. So it just goes back to trade your patterns. If your patterns are met, trade it. If they're not, sit on your hands, do nothing. It doesn't cost anything to do nothing, right? It doesn't cost anything to sit still. Your brain will tell you that you're missing out on money, but the reality is, if your rules aren't met, all you're doing is you're skipping out on some avoidable losses. Trading into a termination and losing is an avoidable loss. Trading without momentum and losing is an avoidable loss. Getting in from the wrong side of triggers is an avoidable loss. Fighting the gap theory and losing because you swore that mid-band had to hold is an avoidable loss. Could you imagine if all you did was take the perfect trend trade 4 times a day, 1 of them lost, 3 of them won? You'd be profitable every day with that recipe. The more maybe trades you throw in there, the more trades that lose that didn't fight the rules, your high probability trend trades have to make up for that. Every hole you dig with an avoidable loss has to be filled with profits before you get onto the good side of your P&L. Think about that. Why throw it away? Is that it? Did we make it?